Today's Nifty market looked extremely active. There was a lot of trading, volumes were high, options participation was heavy, but despite all that activity, price stayed relatively contained. That combination is important because it tells us this was not an emotional market, this was a controlled market. In this video, I will explain how that control showed up across cash, futures and options purely from a structure point of view. Final market snapshot. Let's quickly anchor the day. Nifty made a high near 25,922. The low was around 25,780 and the market closed close to 25,867. So the range was wide, but the close stayed near the middle. Range context. This already tells us something. The market traveled, but it did not escape. Movement happened, acceptance did not. Core market state check. Before we interpret anything, we always run a simple control check. Was trading activity higher than price movement? Yes. Were both calls and puts active? Yes. Did volatility expand? No. Whenever these conditions appear together, the focus shifts away from direction and toward control. Market environment. So the broader environment today was absorption and control. Participation was allowed, but price was managed. Cash market behavior. Let's start with the cash market. Equity turnover crossed 1,14,000 crore rupees. That's higher than the previous session. So participation clearly increased. But even with that increase, price did not trend aggressively. This tells us cash activity was present, but it was being absorbed. Key cash insight. In simple terms, a lot of trading happened, but price response stayed muted. When cash activity is high, but price stays balanced, the next place to check is futures. Because futures usually show whether traders are adding risk or quietly stepping back. Future structure. Looking at futures. Volumes increased, but open interest declined. Futures interpretation. This combination is important. When volume rises but open interest falls, it usually means positions are being adjusted or reduced. So futures were used more for managing exposure, not for building fresh directional positions. So far, everything points to participation without urgency. But the clearest confirmation of that always comes from the option chain. Options participation. Options activity was the most dominant feature of the day. Index options volumes were very high, but overall open interest declined and implied volatility stayed calm. Options insight. So there was a lot of churn. Positions were changing, but risk was not being aggressively priced. At this point, the market still looks busy but balanced. The key check now is how calls and puts behaved separately. Call side behavior. On the call side, near the money strikes saw unwinding. At the same time, fresh call writing was visible at higher strikes. This shows that upside activity was being managed, not chased. Put side behavior. On the put side, writing was visible closer to support areas. There was no sign of panic hedging, no urgency for protection. Volatility check. And through all of this, implied volatility did not expand. Options stayed reasonably priced. That tells us participants were not expecting disorder. When volatility stays calm despite heavy option activity, it usually confirms one thing: control. Strike interaction zone. Most of the meaningful activity stayed concentrated between roughly 25,700 and 26,000. That was the main interaction zone for the day. End of day summary. So if we put everything together, participation was extreme, futures showed de-risking, options showed heavy churn, but price stayed contained. Final market state. That combination defines the structure: maximum participation, maximum absorption. Closing thought. This was a busy market, but it was a calm, controlled one. Disclaimer and close. This explanation is only for understanding market behavior and structure. It does not suggest any action.